When budgets from operational levels are coming to the organizational strategic level, the management need to then review them to make sure that it is in line with their strategic objectives. The top level review is done through performa financial statements. The review of performa financial statements have various objectives, including checking whether the budgets are in line with the planned targets and strategic objectives which have been communicated to the operational level. Have they followed the strategic objectives while preparing these budgets? It also helps management doing a what if analysis, where management might see that if the budgeted revenues will not be achieved or budgeted cost will increase, what they're gonna do, and they will check other scenarios where maybe finance will not be available or cash difficulties may arise. So they will use these pro forma financial statements to analyze the financial statements. Pro forma financial statements also give management an insight of their financial needs. If they need to borrow some finance, for companies, retained earnings are one source of finance. Internally, they can fund their companies using the retained earnings. But there are also external sources of finance which have some cost, like debts and raising equity. The cost of debt is generally lesser than the cost of equity, and so the management need to see whether they need to raise any new finance and through which sources they can raise it, and what will be the cost of that finance that they are arranging. This also helps company to structure their capital, making a balance between the debt and equity. We call it gearing as well. Is like how much of debt is required, how much of equity portion the company would keep in proportion to the debt. Then we will also try to see the budgets which are prepared are giving a realistic picture of the market demand of the product, and also is it in line with the top level management's plan, and so the goal congruence between the internal and external information available. They will process it and then try to make sure that the performance financial statements are giving a realistic view of what to expect in the future. While preparing the cash forecasts, the company also try to see what are their short-term or long-term requirements for the cash, and also the factors which are influencing the short-term or long-term forecast of the cash. The factors which are affecting the short-term forecast include the cash operating cycles, commercial patterns, credit facilities, and planning of financial projections. The long-term forecast would be impacted by the repayment capacity of the loans, also the cost of capital for raising new finance, and also the management strategy about keeping the long-term cash with them and how they're going to use it. Sometimes the company, when they have need for fixed assets, they might need more cash to disperse it. One of the most important objective of reviewing the budgets and making performance financial statement is to checking their effects on the debt governance on the financial forecast. The debt governance are those terms and conditions which are embedded within the debts that the company have previously acquired. So we need to understand the nature and the type of different types of terms and conditions which are important for the financial forecasts, and also the financial stability which may face some constraints by the covenants. For example, some of the covenants may say that if the company's cash flow ratio will go below certain value, the company need to repay some of the amount back to the loan provider. So such a covenant will be there. The company need to see their financial stability. The covenants which are embedded within the debts may give some kind of conflict when you are planning for raising finance. So we need to see whether there is any conflict and we can remove it. The debt covenants may also restrict the company's ability to raise more finance, or further change the capital, the debt to equity ratio, or the gearing ratio we call it, the capital structure that we have, how much debt or equity they have. The debt covenants may pose some restriction on it, so company need to see whether they have some kind of restriction or not. And also some of the covenants may restrict companies having their strategic plans. So if you are going to invest into certain areas, there might be some restrictions on that. So company need to see whether the performance financial statements are helping them coping with those constraints which debt covenants may pose. When performance financial statements are in hand, the company use it to also perform sensitivity analysis. I will try to show you the way what if scenario, the way sensitivity analysis work with the financial statements. So let's say we have performance financial statements in hand. We have balance sheet and income statement prepared with us. Assume that we have cash 9,500, account receivables 15,500, inventory 17,000, making a total current assets of 42,000. Long-term investments in property, plant, and equipment are total 218,000, and so the total assets are 160,000. On the other side of the balance sheet, we have liabilities, which include current and non-current liabilities. It includes account payables, note payables. Notes payables are generally short-term arrangement of finance, so we can raise finance having these short-term note payables. Accrued liabilities are unpaid expenses generally. Long-term debts are bigger loans that you have to pay after one accounting period. On equity side, we have common stock, additional paid in capital, and retained earnings, totaling up to 160. So both the sides of balance sheet are equal. In on the income statement, we have net sales, cost of goods sold, giving a gross profit, other expenses, giving you operating income. After this, we subtract the interest from this. You will get earning before interest and tax. Minusing the tax, you will get net income. This is pro forma balance sheet and pro forma income statement in hand. Assume that the fixed assets here are being used 75% of their capacities, and last year dividend was 1000. This will grow at a rate of 5%. That means this year we will have 1050 as dividend. If the company wants to be able to fund its growth internally, what is the maximum rate of sales growth it can achieve? First thing we need to see is that currently what is the sales level, and currently the assets, the fixed asset we have, property, plant, and equipment, they are working at a 75% capacity. If I will use it to 100% capacity level, how much sales can I generate? And if there is a possibility to increase sales to a certain percentage by using fixed asset at a full capacity, what will be the impact on the other items on the balance sheet? We see here that the net sales are 100,000, and these are using 75% of the asset utilization. So if assets will be used at 100% capacity, we can achieve a sales of 133,333, which gives a 33.33% growth. Meaning that if assets will be used at full capacity, we can achieve a 33.3% growth in sales. To achieve this growth in sales, we will have more cost of goods sold. There might be increase in the expenses, and so our operating income will also increase. Our finance cost might not increase because we want to fund the growth internally. We don't need any external finance. So finance cost is fixed cost on the loans, so it might not increase. Tax will be applied on whatever the earning before interest and tax will be, and so net income will increase. So that means if we will try to have 33.33% growth in sales, it will not only be an impact on sales, but also it will run down to the bottom lines of net income as well. Further, there will be also impact on the balance sheet. On the balance sheet, you see the cash will change because we have sales figure changing. Account receivables will change, and inventory levels will change. Of course, there will be no direct change in long-term investments because it have no connection with the net sales. And property, plant, and equipment, we do not want to buy any new because we have excess capacities and we're using it at the full. Account payables will change. Note payables will not change because we want to fund the growth internally. That means we are not going to get any external finance. Long term or short term debt both are not changing. So accrued liabilities and account payables may change. On the equity side, our common stock and additional paid in capital will remain same, but retained earnings will change because of the new net income that will come up, and also there will be a new dividend that we need to pay out. To understand and calculate all of these, let's see that as I've already shown you that sales can go up 33.33% if assets are being used 100% capacity. The other impact on the balance sheet is that the current assets 42,000 will increase by the growth percentage, whatever it would be. Liabilities will also increase by growth percentage. The equity will have profit added and dividend subtracted. So in profit, you see the operating income plus growth in the operating income minus interest and tax is removed. So we are taking operating income, add into it increased operating income on the increased sales. Interest remains same because no external finance taken. Tax rate will remain same, so 1 minus tax is 70%. And dividend is growing by 5%. Solving all of this equation, we will get 6510 minus 8400 G. Now, assets minus liability minus equity on the pro forma financial statement is what is the finance required. If asset side is more and liability and equity side is less in the pro forma financial statements, it means that we have more investment to make whether in the working capital or in the fixed assets, we need more finance on the other side, either by liabilities or delaying payments or doing anything, increasing liabilities or increasing equity. So if there is a difference between assets and liability and equity side, we make an assumption that we do not need external finance. We want to fund the growth internally. So I'm keeping that zero. And so change in assets minus change in liability minus change in equity should be zero. Solving this will give me a growth percentage of 28.8. This means that although using assets at 100% capacity may give me 33.33% growth in sales, it gives me a margin to have that much of sales, but I cannot go above 28.8, otherwise I will need more finance. So to back the working capital required to fund the growth in sales, I can only go up to 28.8%. And that was your question. The question was asking you to what is the maximum rate of sales growth we can achieve. So we can go only up to maximum of 28.80. So this is how we analyze the pro forma financial statements by looking at change in one item. In my case, I've taken the example of changing sales. It can impact the profits, and then it can impact the working capital and the other side of the balance sheet, and how we actually work that out. Then this is the finance required.